today's podcast, we'll be looking at the recent spate of banking acquisitions across the English-speaking Caribbean. According to The Economist magazine of October the 18th, the number of mergers, acquisitions, and investments worth over $10 billion is at a record high, with the third quarter of this year being one of the busiest in acquisition history. Even more pertinent to the discussion at hand, the rules in the United States surrounding bank mergers are being loosened, and Fifth Third Bank is currently on the cusp of acquiring Comerica to become the ninth largest bank in the United States. However, acquisitions are notorious for not delivering on their stated goals. This is especially so in the financial services sector, which is replete and ripe with examples of spectacular failure. Whether it's the disastrous Bank of America acquisition of Merrill Lynch in 2008, or the fallout from the botched Royal Bank of Scotland acquisition of ABN AMRO in 2007, banking acquisitions have both a history and a habit of flattering to deceive. Closer to home, in the Caribbean, over the past 6 years, there has also been a wave and heightened level of acquisition activity within the banking and financial services sector. What has driven this recent development? For the vendors, why have they sold? Were there compelling value propositions from the buyers? Will they succeed and lead to an overall strengthening of the banking sector of the region? In this episode of our podcast, we'll try to address some of these issues and other questions as they relate to the recent spate of banking acquisitions in the English-speaking Caribbean. But before diving into the details of these acquisitions, it may be useful for us to look at and to identify the key factors or drivers to successful bank acquisitions. Here we can point to at least 8 key drivers: strategic fit, cultural and organizational integration, synergy realization, robust risk management and due diligence, strong post-merger integration and planning, strong leadership, communication and governance, and last but definitely not least, technology and system integration. The most successful acquisitions always begin with a compelling value proposition, and not simply a goal to grow a market or to become larger. Some common reasons for acquisitions include expanding into higher growth markets or attracting new customer segments. Another strategic or compelling reason can be geographic or even currency diversification. From a financial performance perspective, cost synergies often play a critical role in the success of most acquisitions. Whether it is rationalizing overlapping branches and back offices, or combining procurement, technology, and vendor contracts, the successful mergers are invariably those which track, measure, and deliver synergy targets rigorously. Banks are also perhaps the most regulated corporate entities anywhere in the world. Consequently, hidden risk such as credit quality, compliance gaps, AML exposures, and cybersecurity vulnerabilities can compromise transactions. To avoid this, deep due diligence and strict adherence to regulatory obligations is compulsory. Oftentimes also, many bank mergers stumble over IT compatibility. They also stumble because of duplicated systems, core bank systems misalignment, or data migration errors. All of these can be disastrous for an acquisition. Early tech integration planning is therefore critical to maintain customer experience and reduce operational risk. Finally, and perhaps most importantly, post-merger integration must be scoped and clearly articulated long in advance before the deal closure. In this regard, and here it goes without saying, it is extremely important that there is a clear roadmap for merging systems, HR, and compliance and governance. So let us see what has been happening on the ground in the Caribbean space over the past 6 years. In 2019, the Republic Bank Group acquired the regional operations of Scotiabank in Anguilla, Dominica, Grenada, St. Kitts Nevis, St. Lucia, St. Vincent and the Grenadines, and St. Martin in a deal worth approximately US $123 million. In 2020, Caribbean Investment Holdings Limited, the parent company of the Belize Bank, acquired the operations of Scotiabank in Belize with a reported price tag on that transaction of US $30 million. Also in 2020, Eastern Caribbean Amalgamated Bank acquired the assets of Scotiabank in Antigua and Barbuda after the Prime Minister of Antigua blocked the sale of these assets by Scotiabank to the Republic Bank Group, insisting that the assets be sold to a local entity. In 2022, a consortium of indigenous banks operating in the Eastern Caribbean came together under one umbrella and purchased the assets of the Royal Bank of Canada in the Eastern Caribbean. In this case, the consortium included the First National Bank of St. Lucia, Antigua Commercial Bank, the National Bank of Dominica, Bank of Montserrat, and Bank of Nevis. In 2021, the year before that, another consortium of indigenous banks, comprising of the National Bank of Dominica this time, the Grenada Corporate Bank, St. Kitts Nevis Anguilla National Bank, and the Bank of St. Vincent and the Grenadines, they acquired the operations of CIBC, First Caribbean, in several Eastern Caribbean countries after an initial bid by CIBC to sell those operations to a Colombian entity did not meet with regulatory approval. And finally, in 2024, in a deal worth approximately US $143 million, Republic Bank acquired the operations of the Cayman National Bank in the Cayman Islands. Now, who were these vendors and why did they sell their operations in the Eastern Caribbean at this time? A cursory analysis of each of these transactions, with perhaps the exception of the acquisition by Republic Bank of Cayman National Bank, will highlight the fact that the vendors involved were all multinational or international banks operating in the Caribbean. Another interesting dimension and footnote is the fact that they were all Canadian banks, Scotiabank, RBC, and CIBC. Each also had operated in the Caribbean for many decades. But why did they sell? And why seemingly all around the same time over the past 6 years? Here I believe that there are 4 main reasons which drove the sale of these banking assets during the past 6 years. With returns falling and risk rising in the post-COVID environments, these banks were forced to reevaluate their overall positions, not just in the Caribbean, but internationally, with the result being a decision to concentrate on core geographies as well as higher risk-adjusted return markets. This decision invariably led to a reduced concentration on lower priority countries' operations, such as the Caribbean. As a direct tangent to the foregoing, post-crisis capital management and tighter regulatory expectations from home regulators in Canada created an environment in which which made the maintenance of small country operations both expensive and capital inefficient versus simply retaining capital to their shareholders or simply reinvesting in other markets. Another reason and another catalyst for the flurry of bank sales, which we witnessed in the past 6 years, stem directly from the operational complexity of conducting banking business in the Caribbean. Even though the Caribbean region is geographically small, with an overall population of just over 6 million, any international bank operating in this region is requested to report to at least 6 different banking regulators and central bank. Additionally, maintaining many small country systems with local compliance, legacy IT, and branch networks can be costly. Consequently, it is more than likely that many of these vendors, RBC, CIBC, and Scotiabank specifically, would have sold their operations to avoid ongoing or even mandatory modernization burdens. A rationale which is perhaps less well understood, but was nonetheless a key driving factor in the exit of these banks from the Caribbean, revolved around the concept of trapped excess capital. So what do we mean by trapped excess capital? In some jurisdictions of the Caribbean, especially where there is still foreign exchange control regimes, some international banks, even when they are highly profitable, encounter severe difficulties when attempting to repatriate capital or pay dividends to their shareholders, either in US dollars or Canadian dollars. This phenomenon poses a serious problem for international banks, which may have excess and sometimes undeployed capital trapped in these jurisdictions for many years. This issue of the inability to repatriate capital, if and when they need to, has 2 further deleterious implications and consequences. By having more capital than they actually need in a particular jurisdiction to run their operations, the return on equity for these entities would be negatively impacted, invariably. But perhaps even more seriously, from a financial perspective, these entities all face currency risk in the likely scenario that a devaluation would occur within the country in which the capital is trapped. So we now have a clearer picture of what drove Scotiabank, RBC, and CIBC to sell certain aspects of their Caribbean portfolio over the past 6 years. And what were these? Strategic refocus, capital and regulatory concerns, operational complexity of running small operations in multiple jurisdictions, and foreign exchange control, which led to trapped capital in these jurisdictions. Let us now examine what was perhaps the motivation behind Republic Bank and the other indigenous banks of the Eastern Caribbean for purchasing the operations of these entities. Republic Bank's acquisition of Scotiabank's operation in the Eastern Caribbean and St. Martin was part of an overarching strategic plan to expand its footprint in the Caribbean whilst diversifying its income base and increasing business opportunities for its clients. The acquisition allowed Republic to increase its market share in the Eastern Caribbean while giving it a foothold into the St. Martin market, a market in the Dutch Caribbean, and a market, interestingly, in which Republic Bank did not previously have a presence. The acquisition also added heft to the group by adding $2.5 billion to its US $10.5 billion balance sheet at the time. Not insignificantly, the acquisition was also accretive in terms of its earnings by Republic Bank. it was accretive to the extent of US 20 cents. Having operated in Cayman Islands since 2006, Republic's acquisition of Cayman National Bank in 2024, at the time the largest domestic bank in that jurisdiction, seemed to have been an ongoing part of Republic Bank's long-term expansion strategy. In so doing, it allowed Republic Bank to streamline its operations and to place it in a position of dominance in the Cayman banking sector. Strategically, it also gave Republic Bank access to a large pool of US dollar income. While the acquisition by Republic Bank of Scotiabank operations in the Eastern Caribbean and the Cayman National Bank seem to have been very deliberate and an integral part of our long-term strategic objective, the acquisition of RBC operations and that of FCIB by indigenous banks in the Eastern Caribbean, on the other hand, seem to have been more opportunistic. In 2019, 5 financial entities operating in the Eastern Caribbean region acquired 7 branches of RBC operations in those jurisdictions. These acquisitions followed the decision by RBC to withdraw from the region and provided an opportunity for these indigenous banks, to play a greater role in the development of their respective economies. A unique aspect of this acquisition was the fact that these 5 indigenous banks from different jurisdictions within the OECS were able to work together in a bid to make a joint offer for the operations. The transactions gave each of these banks increased size and scale and allowed each and every one of them to play a more active role in the development of their respective economies. Not unlike the acquisition of RBC operations by the 5 indigenous banks, the acquisition of CIBC's operations in the region followed a similar pattern when in 2022, CIBC FCIB announced the sale of its business to 2 indigenous banks in the Eastern Caribbean, the Bank of St. Vincent and the Grenadines and the St. Kitts Nevis Anguilla Bank. In this case, and in the case of the St. Vincent acquisition, it allowed the St. Vincent National Bank to grow its portfolio from what was then a hefty 52% of market share to an even more dominant position where it was able to hold 67% of the market after the acquisition took place. The case of the Belize Bank acquisition of Scotia's operation in Belize is perhaps a more interesting case study. At the time of that acquisition, credit expansion in Belize in the banking sector was quite negligible, averaging less than 1% per annum for the preceding 5 years. Consequently, the Belize Bank acquisition of Scotia's operation allowed the bank to significantly expand its loan portfolio and market share at a time of declining growth in the market. Additionally, having had previously very limited exposure to the retail and residential mortgage market, the acquisition also allowed the bank the opportunity to diversify its portfolio, since Scotiabank was at the time the main lender to the retail sector and the mortgage lending business. Portfolio diversification and the prospect of gaining access to Scotiabank's low-cost term deposits, along with the opportunity to cross-sell existing products, made that acquisition case even more compelling. Additionally, with the 9 Scotiabank branches also operating in very close proximity to the Belize Bank 12 branches, which were spread throughout the country at the time, the acquisition also presented the opportunity for the streamlining of operations and for tremendous cost savings. So where are we? Let me see if I can summarize and pull everything together. The recent flurry of acquisitions in the Caribbean have been driven by Canadian banks previously operating in the Caribbean, having to streamline their operations in the aftermath of the COVID pandemic. The need to streamline operations, the regulatory challenge of reporting in myriad jurisdictions in a relatively small region, and the risk of having trapped capital in a soft currency jurisdiction made the case even more imperative. The imperative created an opportunity for indigenous banks to then purchase assets and portfolios of loans which they would otherwise have not had the opportunity to do. While it is still early days yet, and we do not know exactly how these acquisitions will pan out, early evidence suggests that in all the cases discussed, the acquisitions were earnings accretive and have added significantly to the underlying value of the acquiring entities. Even more importantly, with the move from foreign to domestic ownership in the banking sector, the underlying and respective economies are also poised to benefit from banking teams and personnel who better understand the idiosyncrasies of their respective economies and the specific needs of their clients. But challenges remain nonetheless. System integration, software alignment, cultural fit, and perhaps, most importantly, the perennial and persistent threat of de-risking. The lesson, in summary, is this. In finance, based on observations over the past 3 decades, we can say categorically that though growth through acquisitions sounds glamorous, success ultimately depends less on the deal itself, but more so on disciplined integration, culture, and execution. Something to think about. A word to the wise.